So you could say what the strength or weakness of the momentum is by where price is, the current price, minus the settlement price of 10 days ago, 5 days ago, 50 days ago. So that's how you can utilize a momentum study, and there is a momentum indicator that uses that exact formula. But candles, they help, and they are the second dimension of what we're using pivot point analysis for, to help us identify the change in momentum in a visual approach, and that will help us calculate the momentum of the market. Now, what I'd like to get into right now is the moving average section of pivot point analysis, but first let's go over what moving averages are about. First off, the name moving average describes the calculation and the result of this indicator, which is simply a moving average, which is the most popular. Very much, I use a simple moving average in most of my analysis, as we will here in this trading course. Other moving averages include exponential, weighted, and variable, and of course you can do displacements by subtracting time periods. There are more complication and more complicated calculations. Just remember this. You want to have any type of an indicator. The least amount of time periods will make the indicator more sensitive to price changes. And again, with exponential and weighted and variable moving averages, they use, and they're a little bit more complicated, but their calculations make the indicator more sensitive also to the latest closes by weighting the last close price or the latest closing price based on various formulas. Most foreign currency Forex platforms offer these as standard tools. Now, a simple moving average is simply you add up the sum of the closing prices by the number of closes. For example, if you take an 18-day simple moving average based on closing prices, take the last 18 days close, add it up, divide by 18, and that will give you your 18-day current simple moving average price. With each new day or time period, it could be 5-minute, 15, 60, daily, weekly, monthly, whatever your time period is. It's just whatever that closing price is, you add it to the new calculation while the first closing price is eliminated. That is what we're looking for, freshening up an 18-day moving average, and that's why you look at a calculation that's called a moving average, because it moves. So you drop the oldest, add the newest, add them up again by 18, divide by 18, and there you have your 18-day moving average. Now, if you recall, we talked about the pivot point calculation, providing the mean, the average for the session's trading range. We take the high-low close, divide by 3. That's our pivot point. Well, the purpose of using the pivot point in the moving average calculation is that the pivot point will show the potential continuance of the trend, the strength of the trend, and the typical price. If you add the high and the low up, after all, that was a trading session. Activity took place. There was volume during that session. People remember who sold the low and the market rallied on them. People remember buying the high. They remember that price. They're scared of that price. They're fearful that the market breaks that low. So the low and the high are very important price elements. The close is obviously important. That's just an assigned price level. But if you combined the low and the high and the close, that gives you more truer indication of the true value of the market of that given time session. So the number utilizes the number, meaning the pivot point number, will utilize the cumulative data from the high, the low, the close for a given session. So that information provides what I call a clearer picture of the average true price for that time period. So once again, the pivot point, add to the pivot point, add another pivot point, and divide by 3. Friends, that is right there, as I'm showing you, a moving average, a 3-period simple moving average of a pivot point. And that's what I wanted to really highlight for you, is that if you take a day of, say, Wednesday, and then a day of Tuesday, and a day of Monday, if you add up and take the pivot points from those 3 days, add them up, that's going to give you the true typical price for those 3 time periods. That is a 3-period moving average of the pivot point. That's what this number is. And that number is giving you a truer reflection based on the values of the high, the low, and the closes for not only one session, but all 3 past sessions. So that, I think, is something that it's a kind of a new twist for most of you, and especially if you've never seen my work before. Let's talk about this and show this in graphic detail. We've got our pivot point as indicated by our boxed line. And then let's take our longer term, what I call 3-period pivot point.